All right, good afternoon, everybody, and thank you for joining us today. We have some people who are here in office with us, and then a lot of you are joining virtually, so thank you to everyone for joining us. My name is Colleen Bentley. I'm the marketing manager here at Private Vista, and today we have one of our partners, Jeff Toner, with us, and he's going to be presenting the Illinois Tax Exodus, Stay or Leave. Jeff is going to discuss this timely and popular topic of whether or not to move out of Illinois for tax purposes. Before we get started, I just wanted to touch on a few housekeeping items. So the first item is that we are recording this webinar today. So everyone who is registered will receive an email, and that will have the full recorded version in case you want to reference any of the slides. Second, we will be answering questions at the end. So you can submit questions at any time during the presentation on the right-hand side of your screen. The questions will only pop up to us. And if you have any questions that are specific to your situation, feel free to contact us directly, and we'll have all of that information available at the end of the webinar. I think that's it. So that being said, I'm going to turn it over to Jeff, and we'll get started.
Good afternoon. Again, thanks for attending this. I think that the topic today is somewhat timely in the sense that when I'm out and about and discussing things with clients and just people in general, people obviously this topic is something that is being discussed around the state. And really the purpose of today is to give you enough ammunition, so to speak, so that you could actually analyze this or actually get your arms around the issues and the topics that you should be looking at when you look at this particular issue. So let's start the session, and we're going to go through, here's what we're going to do. We're going to give a little background just on the whole issue of being a resident in Illinois or moving somewhere else. We're going to go through the reasons that people choose to stay in Illinois. We're going to go through some reasons that people do leave Illinois. We're going to talk about if you make the decision to leave Illinois, what are some places that a lot of people consider and why in terms of moving to different states. Then we're also going to talk about if you've made that decision to move, what you need to do in order to make that official. So we're going to cover that as well. And then, as Colleen said at the end, we're going to leave a little time for questions. And if for some reason we can't cover all the questions today, we will get back to you and make sure that your questions are answered. So with that, let's just give a little background to this whole issue. So it is a fact that there are a number of people that have left the state of Illinois for various reasons. Some statistics that we have is 100,000 people have left Illinois in the last 8 years, and that can be for a number of reasons, but some of them will be for the reasons that we have discussed. The other, what may be the more interesting statistic, there was a poll done by a group called IllinoisPolicy.org, and they just asked people, have you ever considered leaving the state of Illinois? And over half of the people have said that they have. So that's a big number when it comes to, what effectively happens in the future. If it's on their radar, it means they're starting to think about it, which, could mean that eventually they make a decision to do that. The second part in terms of the background is, when you ask the question why, and you really dig deeper into it, really there's one predominant answer. It's taxes. But the issue when you deal with and talk to each person and you say, well, what do you mean by that? It could be any number of taxes that are of concern to people. And it really depends on their individual circumstance as to which reason that they are choosing to leave. So we're going to go through that today. We're going to cover some of these different taxes to give you an idea of how they apply and what actually they are, and then compare and contrast that to some of the states around us. So this is the background kind of to what we're going to go through, and so with that, let's go to the next slide. So this is the elephant in the room. Should you leave? And the answer is, it really depends. So the session today isn't going to give you that answer that you can walk away and say, I absolutely know what I'm going to do. We're suggesting you really need to take into account both financial and non-financial reasons when you make this decision. And they're going to be very individual to you and your priorities and your goals and dreams. So there's not one answer that fits all. But we want to give you enough background that at least you, in a sense, understand the process that you should go through to help you make this decision. So let's first talk about potential reasons to stay in Illinois. Probably the number one reason, you're from here, your family's here, your grandkids are here, your friends are here, your church may be here, your community may be here. So I would think the number one reason that people would list as a very important component would be the relationships that you have with the people that live here. The other reason, in this day of the opening game of the Bear season is, people like their sports teams. They like their city. They like the culture of their city. There can be a lot of reasons that people just like, living in the city or the state that they're in. So that they can be significant factors in terms of why people choose to stay. Okay. So let's start getting into some of the details about the various states. We just put up here a chart of the United States, and if you look at that, when we look at that, we go from what we call most tax friendly to least tax friendly. And so one of the things that you'll notice on the coding is that if you look at where Illinois is, it's right in the middle. I think most people would look at this and say, I just assume it would be the least tax friendly. But if you remember that what we're looking at here is we're looking at the taxes on people that are retired. And one of the biggest reasons that Illinois is in the middle when it comes to retirees is in Illinois, you don't pay a state income tax on the following things: Social Security, if you have a pension, and if you get withdrawals from your IRAs. So from Illinois, if those three things were kind of the primary ways that you were receiving your income for retirement, it's a fairly tax-friendly state when it comes to the income tax that you would pay on that amount of money. So let me give you an example. So let's say that we had a couple in their late 60s, and they had Social Security income of $35,000. They had a pension of $50,000. They were taking a withdrawal from their IRA, which we refer to as a required minimum distribution, of $50,000. And then they're getting some dividends and interest on their portfolio of about 10 and 10. So their total income in the year was $155,000. And their net worth or asset values were below $4 million. So if we go to Illinois and just say, how is that taxed? Here's how it would look. Social Security would not be taxed at all. The pension would not be taxed at all. The IRA would not be taxed at all. So the only things that would be taxable would be the dividends and interest from Illinois. So when you go down and you figure out what the tax on that is, the tax is $760 of tax on $155,000 of income that came in. That's less than a 1% income tax rate on the dollars that came into the household. The marginal rate on that, on any extra dollars, whether it was income or earnings on your investments, the marginal rate today is 4.95%. If we compare that to California, if you went out to California, you still wouldn't pay tax on Social Security, but you would pay it on your pension and your IRA, and you'd still pay it on your dividend and interest. So under the same scenario, the taxable amount would be $120,000, and the tax on the net income would be over $5,000. So the effective rate would go up to 3.3% of the money that you earned. And the other thing in California in this bracket, any additional dollar that you added to this situation, every marginal dollar would be taxed at 9.3%. So you can kind of see, if you're just looking at, how retirement income is taxed between one state or another, Illinois is fairly attractive on this particular item in terms of taxation. So let's cover potential reasons that you might consider leaving Illinois. One of the taxes that we don't hear a lot about, but can be fairly significant, is something called an estate tax. So we might be familiar on the federal level that the estate tax is, each person has an exemption for about $11.4 million. If you're married, you can shelter basically double that amount of money. So you don't pay any federal estate tax if you're basically at $23 million or less of asset value. The chart you're looking at here has to do with state estate taxes. And the first thing you'll note is most states do not have them. So if you look at this just as an overview, the vast majority of states do not have estate taxes. And then if you look at the color code, there's semantics between something called a state estate tax or state inheritance tax. But there's only a few states that really have them, and Illinois is one of them. The list that you have on the left-hand side shows you the states that don't have them, but it also lists the states that do have them. And if you see what's highlighted in Illinois, it basically says if you have assets above $4 million, you will pay an state estate tax, and that rate will be 16% of whatever is over that. If you're married, you have the potential of doubling that, but it's very complicated, and you really need to work at it from an estate planning structure to make sure you've done that. It's much more difficult than the federal way that it's calculated. So with that, we're going to now switch to something called income taxes. So this got a lot of publicity a few months back. Illinois is going to have a constitutional vote on whether Illinois can change from a flat tax into a progressive tax. This vote comes up next November, so it's a while away. But the income tax law that has been proposed is this. So if you look at this chart, what it basically says is on the first $250,000, there's a little progression from 4.75 to 4.9 to 4.95. Basically, it's very similar to the flat tax that we have right now. But if you go to the right-hand part of this chart and you look above the graph, it says if you're single and you make over 250 to 350. If you're joint and you make over 250 to 500, and then you can kind of see the two progressions after that. If you make more than that, it's going to jump up to 7.75 and go all the way almost to 8% on those dollars. And the second part of the proposed law is if you as a single person exceed 750 or as a joint basis exceed $1 million, it effectively becomes a flat tax. It says all the way back to $1, you'll pay 7.99%. So right now we're at 4.95%. If you earned over $1 million and were married, that tax would go from 4.95 to 8%. So that's the proposed income tax change. A lot of things have to happen between now and then. It has to go up for the vote. It has to be, if it goes up from the vote, it would then have to be passed by the legislation. But this is what the proposal is. And the odds would be if this did pass and it was put into place, my best guess is it would be 2021 when this would start to be effective. Okay. So another tax that people talk about a lot around here is the property taxes. Okay? So the property tax, if you look at this chart, it lists 51 different entities. So it's including the District of Columbia. And if you look, Hawaii, just let me give you for instance, Hawaii says that they tax 2.27% of the value of a typical house. And if you go all the way down to New Jersey says we tax at a rate of about 2.44%. So there's a wide gap, so to speak, of what people pay of property taxes on their homes. Illinois, it's not last, but we're darn close. We're 50 out of 51. And so Illinois' tax rate is about 2.31% of the typical market value of a home. So if you have $1 million home, what that generally is saying is you'd pay about $23,000 in property taxes. So again, property taxes could be one of those items as people are looking at these things that would say, hey, I don't want to pay this much in property taxes. So they would be looking at that and comparing it to what they'd pay in different states if they did move. All right. To keep the fun going, we're going to talk about sales taxes. So this is you go into the store and you buy something. What is the tax, the sales tax that you pay on this? And I would put a caveat in here. Each state, it's relatively complicated because different states might tax, food and medicine differently. And so you really, to do this correctly, you'd have to get into the weeds about it. But what this chart looks at is, on average, what are people paying in a sales tax on items that they buy, at a store and consume. So again, there's a scale here of lower to higher. There are a few states, and the emphasis on few. There's 4 states that really don't have a sales tax. Every other state does have a sales tax. And if you look at the numbers in this chart, you would see that they range, between somewhere in the 5% range to the 9% range. Illinois, if you look at that rate, Illinois is about a little less than 9%, 8.74%. That gets us ranked as number 7 out of this particular chart. Number 7 highest, just to be clear on that. So we have a fairly hefty sales tax compared to other places. But I would say most other places still have sales taxes. So when you look at this, it's going to be different from state to state. Okay. So let me go back. I wanted to kind of give an example. We just covered a lot of taxes here. So we covered, income taxes, property taxes, sales taxes, estate taxes. So there's a lot of different taxes when you're thinking about this that you really need to think about. What I'm going to do is just go through an example dealing with income tax and estate taxes, just to kind of give you a comparison here. So let's go through this example. It's slightly different than the one we handled before. So Social Security is $35,000. They don't have a pension. They're not taking an RMD, but they have a big portfolio where they're getting $150,000 in dividends, and they're generating about $50,000 of interest off of their portfolio. So their total income is $235,000, and they have a net worth of $15 million. So let's see how Illinois handles that particular situation. So Illinois, there's Social Security is not taxed. Dividends would be fully taxed. Interest would be fully taxed. So the taxable income would be $200,000. The exemption's $4,000. The amount that Illinois would collect state income tax against would be $195,000, and the actual tax you'd pay would be $9,675. The one tax that is new to this chart is this says that Illinois, assuming that you could use the 4 million times 2, you would still have $7 million of assets above that number. And at a tax rate of 16%, that a state tax rate that you would pay to Illinois would be over $1 million. In the practice that we run and the situations where we have discussions with clients, this is the tax that, one, most people don't know about, and two, frankly, they're really surprised at how much it is when you apply it against their assets. And I would say, just as a side note, more people that we deal with change their residency because of the estate tax than probably all the other taxes, because it's a way to potentially avoid it. So let's go through an example. Let's say that you said, I'm going to move to Florida, and we use the same scenario. Florida does not have an income tax. So you can look at that, and it's fairly easy to calculate, because if you don't have one, you don't pay one. So you pay zero income tax. The other part, Florida does not have an estate tax. So if you compared and contrast Illinois versus Florida, you would see that not only do you not pay the income tax, you don't pay the estate tax if you die as a resident of Florida. So fairly dramatic, fairly different outcome based on where you're a resident of. Okay, so we've just covered a lot of information, a lot of numbers parts to it. And as I emphasized before, I think really if you're going to go into this, you're going to really need to look at your specific situation and go through some of this process to understand it. But let's say that you've made the decision to move. What we have here is a chart that really looks at and kind of puts in different columns the various states and what they consider very tax-friendly to not tax-friendly. And you can read the little script under each one, and it's a matter of degree as you go from left to right, but very tax-friendly states don't have any income tax or very little, no tax on retirement income. It might have a low sales tax, low property tax. It might not have any estate or inheritance tax. So these just give you on a relative basis for the average person where these states would lie based on looking at as many of these tax issues as possible. So don't use this, in a sense, as a laundry list, like, okay, I'm leaving Illinois, so I'm going to Alaska. It's really meant as a way just to start to try to screen down different states based on taxes. But again, you have to look at your individual situation to make sure they're applicable in the same way. Okay, so let's say that you had decided to move. So the question becomes, well, how do I do it, and now what? So what I would say to you is it's relatively complicated in this regard. You just can't say it in your head. You have to actually do things. So here's a laundry list of things that you should do, or at least a majority of these things that you should do in order to really change your residency. And you can go down this list, but it's pretty extensive. So besides just buying a house, there are many things, or moving to a state, there are many things that you need to do to kind of really make it official. And we've put out a few here. The question we get often is, how much time do I have to spend? Well, typically you spend, 6 months or more in the principal residence that you live in. So, we say, typically 6 months or more. You also should register. You should also change your driver's licenses. You should also probably talk to your estate planning person and say, do I need a new will, or do I need a trust that is state specific? You might even change your physicians, your dentist, get your mail delivered to there. So there are a number of things that you really need to do to make it official. The risk is if you don't do these things. Let's say you just bought a house and you started to say, well, I'm a Florida resident, and you haven't done these other things. Illinois could come at you and say, you really aren't. You have a house there, but you're not really a resident there because you don't have a driver's license. You're voting in Illinois. You're getting your mail to Illinois. So you really do need to do these things if you want to make it, in a sense, foolproof from Illinois challenging where you actually are a resident of. Okay. So the key takeaways in this is it's probably more involved than you think. And you should, if you're really considering this, you should really look at it relative to your specific situation. So don't talk to the neighbor down the street and say, well, I'm moving, because my property taxes are awful. You should really look at all these things as it applies to your own situation and compare it to something. So don't just leave Illinois because you don't like paying income taxes in Illinois and go to California, because you're not going to end up in the place that you wanted to be. So you need to really look at all the issues. And one of the things I would say, taxes are only part of the decision-making process. There's a lot of intangibles that go into it that you should take into account when you're making this decision as well. So that kind of concludes the talking part of this session. What I would say to you, if you've heard things, if you're a current client of ours and you want to explore this issue further, just contact your advisor. We have a process that we go through that we can compare and contrast and give you some of this information. If you don't really work with us at present, but you want to kind of get some information on this, there's an email right at the bottom here, privatevistanews@myprivatevista.com. You can just send an email there, and we'll send you back some information that you'll need to provide to us in order to kind of do that comparison. If you want that checklist that I referenced before, the 21 things that you need to do to kind of make yourself a permanent resident of a different state, send us an email there as well, and we'll be happy to send that out to you. As a side note, we have recorded this, and we are going to send out anybody who's on this call a copy of this presentation. So all the slides that we've shown will be available, by looking at that. So that should be helpful if you want to reference any of that. And if you have any kind of questions or any kind of issues you want us to talk to you about, here's our contact information, here's our phone numbers, here's some email addresses. Please feel free to reach out to us. So with that, we'll check to see, if anybody has any questions, they can send them in now, or they can send them in via those contact information. But with that, I'll close it up and wish everybody a good Thursday, and go Bears.